Let's start in East Africa, where Kenya's parliament has passed a law this week that caps commercial bank lending rate at no more than 400 basis points above the central bank's benchmark rate. Bankers, however, disagree. They say the move will drive high-risk borrowers into informal financial services and damage small businesses altogether. This new law also sets the minimum rate for bank deposits at 70% of the central bank's policy rate. Now, the law is meant to address complaints that have been around for years that banks have completely failed to lower their lending rates, even when the central bank cuts its benchmark lending rate. The law, however, isn't quite law yet. It needs assent from President Uhuru Kenyatta before it can come into force. Let's put this into context. That law is the fourth time in 6 years that Kenyan legislators are trying to impose a hard cap on retail lending and deposit rates. As one banker, Mohammed Ulia, explained earlier on today using a medical analogy, capping rates is like treating the symptoms of a disease while leaving the virus that causes it intact.
No, because basically one of the other problems we have and the government has to address is the issue of fiscal discipline. And if the government is borrowing at 22% over the last 12 months, then naturally banks will lend where they think the risk is low, and they get probably the same return as if they were lending to general public and businesses. So the issue here is that you need to cap government borrowing. You don't need to cap interest rates or lending rates in the market. You can't run a fiscal deficit of 8 to 10% and expect lower rate regime. That's impossible. 80% of the loans, 80% of the deposits of the banks come from 20% of the depositors, the 80-20 rule. And when you look at the weight the big depositors carry, it's massive.
Because these guys are coming in and saying, okay, I'll park $5 million with you, but I want 10%, 15%.
Correct. The guys who are basically, the guys with big money are already getting good rates. And also the guys with big money are also getting good rates from the lending side. From the deposit side, they also get, depending on the liquidity in the market, there's at certain times, the banks were paying as high as 17, 18% for deposits. Now, the people who have that kind of deposits, their deposits carry a bigger weight than all, the masses, the mass market in terms of the deposits.
So in effect, the rest of us who are paying this 19%, we're basically paying for their subsidies, essentially.
Essentially, yes. That is true, because basically when you look then at the weighted average cost of funds, it's higher than a lot of people think.
Let's talk about credit scores briefly. I know that the argument banks will make is if I'm lending at 22% to government, I'm basically losing money if I lend money to you, a retail borrower, at 15%, 14%, even though your credit score might warrant that. Yes. Why are credit scores working in this country?
We go back to the structural issues again, and we have issues where bad borrowers or defaulters are basically causing a problem for those guys who have got good records and who can pay. If you look at a bank, they take huge intermediary risks, and these institutions basically will look at the whole picture. They will not look at Rama or anybody with a good credit score and say we will be able to give him at this rate, and yet they are providing for non-performing loans that are massive and huge now in the industry.
But isn't there a credibility problem, especially in the wake of what happened with Chase Imperial Bank? I mean, Chase Bank had a corporate bond out just before it was taken into receivership by the central bank, and the central bank had approved the issuance of that corporate bond before that same central bank then turned around and said, actually, no, we don't like the looks of your books, we're going to put you guys into receivership. That in turn has just frozen over the corporate bond market, hasn't it?
Yes, true. I think we need to strengthen corporate governance. I think we need to also look at, it's not, you see, what we have a problem with is not the regulations. We have good rules, we have good regulations. The problem is enforcement, the problem is supervision. And I think both the Capital Markets Authority and the Central Bank of Kenya need to improve their supervision and enforcement capabilities.